What's up, guys? Tyler Wehrung here, and today I'm just going to shoot a quick video talking about the differences between a regular refinance and a cash-out refinance. We talk about both of these tools a lot, and we've got a lot of questions lately about the difference between the two and which one makes sense for your situation. So we're going to kind of do the normal compare and contrast effort here, where we really are going to start out with a house that you purchased, let's say, 5 years ago. You paid $160,000, or let's just call it after down payments. Your loan balance started out at $160,000, and these are the same on both sides, even though my drawing is probably not to scale. But you started out with a loan balance of $160,000 in both scenarios. Over the past, call it 5 or whatever years, you've paid it down to $150,000. So in both cases, we're going to start out and say today you owe $150,000, but the house has appreciated and is now worth $200,000. So what do you do here? You do have some options, but let's first talk about what a refinance looks like in this situation. So your current mortgage payment is based on the original financed amount of $160,000. So there's a calculation. Basically, they take the $160,000 divided by 30 years and split those up into monthly payments with the interest rate baked in there. But really what you need to know is it's all based on the original loan amount, so $160,000. If we were going to refinance this, the way that works is they would take the current loan amount, so $150,000, and then split that over a 30-year period and get you a new interest rate and come up with, ideally, a lower payment. Since you're spreading out a lower amount over the same amount of time, then that typically lowers your payment as long as the interest rate kind of stays the same or goes down as well. Now, the only drawbacks to this is you are re-extending yourself into a new 30-year term. So if you're 5 years into that term, this would re-extend that out to 30 years, but that's the same in both scenarios here, so really not a difference. So let's talk about now the cash out refinance. So same situation. Started with a loan amount of $160,000, you're currently down to $150,000, but in this situation, the reason why it's called a cash out refinance is now you have the ability to take cash out or get a check at closing when you go to refinance. So the difference here is instead of refinancing now for the $150,000 and spreading that over a new loan term, you're actually going to go back and say, no, I want a new loan for $160,000. And when they do that, the way it works is they'll actually cross out your original loan, get you a new loan for $160,000, and say, wait a minute, but he only owed $150,000, and then you get the difference of $10,000 in cash or a check at closing. If your interest rate stays the same, your mortgage payment should stay the same. You're basically taking advantage of all the debt pay down that you've been paying so far, but ideally you're also going to get a lower interest rate, so your mortgage rate or your mortgage might fall slightly. But the key here is you're going to get cash at closing when you do this refinance, and you're probably not going to drop as much in terms of monthly mortgage payment. Whereas in the refinance, you're not going to get anything at closing. You're just going to go through the whole process, and the whole goal here is to lower your mortgage payment. And the benefit here is you get some liquid cash at closing, but your mortgage payment likely will stay the same or could increase depending on how much you do decide to take out. So let's talk about some situations where these two might make sense. The only time I really recommend a refinance is when you can lower your interest rate by at least 1%. You do have to kind of go through all the paperwork that's associated with a normal closing, so it's really not worth it. If you're not going to drop your mortgage interest rate by at least 1%, you really won't even recognize some of those savings. The other situation is to remove MIP or PMI. Even though these can be, just $20, $50, $60 a month, it's of no benefit to you. You're paying for the bank's benefit to have protection on that loan in case you default. So it is a small amount for most cases, but that you're just throwing money out the window. So if you can get rid of that and lower your mortgage payment at the same time, lower your interest rate at the same time, it could be a win-win. And this is 2021 mortgage interest rates are at historic lows, so this could be a great time to refinance and wipe out that PMI or MIP, assuming you have 20% equity in the property. And the only other time I recommend refinancing, if you don't meet either of those two previous criteria, is if you're just in a situation of distress. Maybe you've had a life change, you've lost your job, and now you don't make as much, and this is your last option that you can't afford your current mortgage payment, and potentially a refinance would put you in a better position with your new job or your new scenario where you're able to make ends meet. But so those are the 3 times that I talk about or really recommend that a refinance might be best for you. So let's talk about a cash-out refinance. And now in this situation, you are taking on an additional risk because you're increasing your loan amount. So let's talk about when that might make sense. All right, so one situation that I've seen people end up better off in a cash-out refinance is to take out this new loan and pay off your student loans. Now this assumes that your student loan interest rate is higher than a mortgage interest rate that you can get right now. I think I saw earlier this month that average student loan interest rates are hovering around 5%. So obviously that's much higher than you can get a mortgage interest rate for. So it could make sense and essentially consolidate the debt, spread it over a longer time period, and pay it on a lower interest rate. So that's one situation. The second is, and this assumes you are somewhat sophisticated. I don't recommend you go out and do this on your first try here, but if you can take advantage of a particular investment opportunity, let's say something that doesn't come around very often, it's very timely, and you have the opportunity to get in to something. Obviously you've done due diligence, and I'm assuming it is actually a good opportunity, and you just don't have the funds. This could be a chance to do that. Whether a rental property comes up, maybe a property in your family wants to be sold and you just need some liquid capital to do that. This could be an opportunity to get some liquid funds in your account, take advantage of this opportunity, and be better off or in a similar situation in terms of monthly mortgage payment than you are today. And lastly, this is a great tool if you're familiar with the BRRRR model, the buy, rehab, rent, refinance, repeat. I talked about this in several other videos. It's a very powerful investment strategy in real estate. But once you're getting towards the end of this cycle, the refinance, that second to last are they're assuming this is a cash out refinance because you've put so much of your own capital into this property. This is the chance to cash out and get your money back out of the deal, ideally leaving you with no money in the property and you are playing with house money at this point. And so if you're experienced with the BRRRR model, the cash out refinance is the perfect tool to wrap up that process right before the final R of repeat, and you can do this as many times as you can. So I've seen many people take advantage of this, myself included. It's how I built my rental portfolio, and it's something you can do as well. All right guys, so I hope that was helpful, just comparing and contrasting the traditional refinance with the cash out refinance and talking about what situations each might work best for. If you have additional questions about your specific situation, drop them in the comments below. And as always, if you got any value out of this video, a like or subscribe would be greatly appreciated. That just tells YouTube that we're not just throwing trash out there. So if you agree with that statement, drop me a like. And as always guys, Tyler Wehrung with Keller Williams. We'll catch you next time.